All right, so I've done a number of studies, different charts, all of that. Now, what I wanted to do is eventually get to a point where we're tracking the market and identifying today's markets and what technical positions they're in. All right, last video I talked about what to look at, from price and volume perspective. So from price, it was relative strength, support and resistance, shakeouts, and the trend along with the momentum, which is indicated by the trend lines, you know, the steepness. And from volume perspective, the climaxes, the low volume pullbacks, etc. Um, so right now what we're up to is selecting the best stocks. So if you're a futures trader, be selecting the best futures. If you're crypto, selecting the best crypto, and if you're forex, selecting the best pairs. All right. So now the first comment here is interesting because he says there are two methods of reasoning. So you have to apply certain reasoning, and basically he says deductive and inductive. What does that mean? It's basically top-down analysis. All right, deductive and inductive is bottom up and top down, and sometimes you use both, like top down and bottom up, and see if that works. But I think everyone knows top down analysis, where you go from like the weekly to the daily to the 4 hour and all that, right? So don't be confused by inductive and deductive. It just means general to the particular means top down, particular to the general means bottom up. In our previous studies, we examined the deductive method of arriving at our decisions. What does that mean? Okay, look at the trend. After that, look at the group. After that, look at the stock. All right, that is the deductive method, top down. So you take a bullish and bearish possibilities, and by taking a look at the general market and all of the other stuff, meaning trend to group to stock to base to all of that. All right. We may, if we wish, do the reverse of this procedure, which is bottom up. I don't recommend this at all because people are pretty bad at it, and you really should go top down. All right. But I mean, if you want to, have at it. Either approach is good by itself, though reasoning from the particular to the general requires the exercise of more skill and judgment and takes more time. So why do it? Make trading easier, not harder. You must learn how to select the best. Here is your position sheet. Now, this is really important. I don't know why any of the practitioners, all of these guys on YouTube and this institute, market, whatever, all of them, none of them use a position sheet. But this position sheet is critical. It is part of the method. Why? What does position and position sheet mean? It means technical position. What is the technical position of the market? Is it about to rally? Is it at a point where it's on a springboard? You know, all of that is what you're tracking with these positions one, two, three, four. All they mean is that, hey, is there a little move, or is there a big move? How do you know if there's a little move? How do you know it's a big move? You have to employ the figure chart. You know, so one, two, three, four. I think one, two is bull, and three, four is bear. One is small rally, two is big rally, three is little rally, and four is big rally on the bearish side. I think that's it, but we'll go through all of that. All right. Now, study and acquire understanding of the inductive method of, okay, whatever. For this purpose, we require a position sheet. As you will see, the sheet is drawn in such a way that you make quick and easy record upon it on your analysis. All right. You study purposes. Okay, only stock 20 stocks is this is another. This is somewhere where people they mess up. What happens for stock traders is instead of taking a look at 20 from the start, what they do is they try to get everything. Look at the group, look at this, that, and it becomes so overwhelming. that they just give up. So if you're following along, I insist that you not go above 20. In fact, better to go less, like 10. And you'll have enough. If you're tracking futures markets, I mean, what are you going to look at? Oil, gold, the E-mini, you know, maybe some of the agriculture markets, maybe copper, and so you have enough, definitely not more than 20. I mean, the others aren't even that active, right? So might look at euro, yen, GBP, and oil, gold, the ES, NASDAQ, and what else? Copper, maybe corn, soybean, wheat. I think that's it. And then for the forex, the majors, right? Or in the crypto, there are too many coins in crypto, but you probably just filter down to the best ones. All right. So anyway, don't go beyond 20. Do not go beyond 20, at least at the beginning. Later on, you can always add and add and add. But the mistake here, again, I want to emphasize this because this is where everybody screws up. Instead of what the instead of doing 20, they try to do 200. All right, big mistake, and it throws everyone off. All right, the position sheet is valuable in forecasting the movements, selecting the best opportunities, judging the turning points, and all of that. I advised a method about 15 years ago and have used it with great success. So we're going to be using the same thing. To make the position sheet, you may begin your analysis with the figure charts. I mean, nowadays you don't have to begin your analysis with the figure charts. In that day, you had to do it because it's done by hand, and making a figure chart was very easy. X is going up and X is going down. Nowadays, is all of that is in your platform. Each day you receive your daily chart. Okay. Following the procedure outlined for M, page 22 and 23, we will enable to observe the behavior in detail and all of that. Okay, every stock is in one of three positions: bullish, bearish, or neutral. All right. So we're going to be doing that. And then place the check mark in your position sheet. All right. Okay, here you go. Here are the positions. Position 1, the stock is going to have a small up move, about 10 to 15%. All right, so it's basically a rally to a higher high. All right, position 2, it's going to have a bigger move, more than just a rally. Maybe it's going to go from sideways trend to an uptrend, or sideways trend to a downtrend. Big move. Big move is the key word. Big move. Position 2, big move. Position 3, a small move down. Position 4, big move down. All right, so let's just go through it again. Position 1 and 2 are bullish, but position 1 is a small move. Position 2 is a big move. Position 3 and 4 are bearish, but position 3 is a small move, and position 4 is a big move. And then finally, neutral position, well, is nothing. You can't tell nothing. All right. Another way of designating position 1 and 3 would be to consider a stock or the market in these positions if it shows indications of a small move, a rally. All right. And in the case of a bearish move, it would be a bear rally. All right. Position 2 or 4, show indications of having a big move. Sometimes you'll have, you know, uh, two a bullish and a bearish indication. So it's in a bearish position for a long move down, but a bullish position for a small move up. Just think of a downtrend that is exhausted and you're about to get a technical rally or a pullback. So it's the trend is down, but it's setting up for a pullback. So it's a small move up, and the number for a small move up is position 1. Here's another one point. When we're going to be entering positions, what do you want to do? Use the wave chart, all right, in conjunction with your vertical line chart. Why? Because it'll give you the low risk entry. 1 and 3 point. The volume indications afford the best means for judging the turning points of these minor swings. I'm gonna show all of that, like how to, it's just basically it's a change of behavior on as the market is pulling back on a daily. You go into a 15-minute, for example, wave chart, and you'll see a change of behavior on it. And there's some advanced tactics here for stock traders where, by taking a look at a bunch of stocks going from position to position, you're able to forecast the entire market, meaning you'll be able to forecast whether SPY will go up or down. Why? Because the markets that you're tracking are all getting ready for a move in the same direction, and you take that logic and apply it to the SPY. Hey, the SPY must be ready for a big move in that same direction. Yeah, you can use the hourly buying and selling rate. You don't have to use a 15-minute. The hourly will do it. Here he's showing, okay, if you do all of this and you add it all up, you sum it up, you'll be able to forecast the entire market based on its components. So this is very powerful, like for stock traders is really good. Okay, I think we're done. Um, for futures trades, you don't have to do any of this. All right. All right, so we're at how to determine the technical position of a stock. Okay, this is extremely important. I'll go over this next one. This you have to pay very close attention to because this is really um, important in how we're going to evaluate all of that, the turning points and all that. All right, so we're up to this. Just remember, creating a position sheet. Figure out what you want to do: stocks, forex, crypto, futures, whatever. Right. The upside of stocks is that you will always find that always there's a stock on a springboard. And you have a lot of variety. The downside is there's too many markets to choose from, and you're gonna have to do a lot of filtering. Same with the futures. It's like you have a ready-made list, right? Like you don't really trade everything. And crypto, I don't know. Forex, I mean, how many pairs are you gonna look at? All right. Anyway, that's all, folks. Take care and stay tuned for the next really important section, which is we. This is what the technical position of the stock or market is required to know, and what we'll be tracking. Okay. Thank you. Bye.